And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is hump day. That means we're halfway through the week, about to wind up the month on Friday. Of course, actually it's Saturday that we finish the month, but technically trading Friday is the last day of the month of May. Then we move into June. So a few things, of course, as we get ready to wrap up the month. This isn't the end of the quarter, so not big trading positions happen, but typically the first day of a new month, so beginning on Monday. Markets tend to get a little bit of inflows, just kind of, hey, it's a new month and, we'll see how things go. It's also, of course, June is winding up the second quarter of the year. So as we get to the end of June, there'll be a lot of positioning potentially for the end of the quarter rebalancing, those type of things. Now, again, because of the correction we had in April, the rally back in May, there's probably not going to be a tremendous amount of pressure on rebalancing because markets are about where they were at the beginning of the quarter as we actually wind up finishing the quarter. So not a lot of big changes despite the very big rally that we've had over the course of really the last few weeks. And of course, that's been really surprising. I was on Charles Payne yesterday, and of course, he's a big fanatic of the markets, and had brought up this big chart showing retail investor buying. Retail investors have had the biggest surge in buying since 2020, which is pretty incredible when you think about it, because back in 2020, we had zero interest rates. The Fed was doing $120 billion a month in QE. We had $5,000, $1,500 checks going to households. We had moratoriums on rent. Everything was shut down. So retail investors people, right? They couldn't bet on gambling. They couldn't, bet on sports because that was all closed down. So they started betting in the markets. And of course, they were buying every little dip that was going on. And following the pandemic, they ran that market right up to new highs. And of course, we had a really strong year that year. 2021 was a big year as well for markets. But interestingly enough, today, and back then inflation was low. Interest rates, as I said, were zero. Today you look at it, we've got inflation running at, 2.4%. It's come down a little bit, but, again, still a bit higher than it was then. The Federal Reserve is actually tightening their balance sheet, not expanding their balance sheet. Interest rates are at 4.3% with the Fed. Borrowing cost for the average American is a good bit higher, but yet you have as much retail buying in the markets right now as you did back in 2020. It's pretty amazing. It's really pretty amazing that these retail investors have come in so hard just post this dip that we had in the markets just recently. It's quite spectacular. But anyways, it was an interesting conversation with him. Of course, he's very bullish, right? So he says, buy the dip. And that buy the dip opportunity is something that we talked about back on April the 6th. We wrote the article called The Hope and the Fear, which is on the website. Saying that, look, sentiment was so bearish at that point, the markets were going to rally. Well, now the sentiment has changed. And we're not that bearish anymore. In fact, we're getting a lot more bullish. But, we're not exceedingly bullish yet. So there's, potentially this market has some more to go here. But there are some indications that we may be getting closer to, at least a period for a pause in this market rally. So just something to kind of think about. We'll get into some of the details here in the next segment, but Nvidia reports tonight. All eyes are on Nvidia right now. All about the AI story. When we talk about AI in general, we talk about Nvidia because they're the lead horse in developing these chips, the backbones, everything else that goes on. So their earnings are this afternoon. Expectations are pretty lofty, expecting a 66% growth in earnings. In revenues for the company. So again, that's not chump change. If you're growing revenue at 66% a year, that's pretty impressive. So there is some risk to the markets later on this afternoon once they report. If they do miss or they change their guidance or they express concerns about a variety of things, that could certainly weigh on markets tomorrow. But going into the announcement, Nvidia had a decent rally yesterday. So we'll talk. Like I said, we'll talk some more about the earnings here in a minute. But let's talk technically about the markets where we are now, and specifically about Nvidia going into the earnings report to try to kind of gauge what the move might look like, depending on whether it's a hit or a miss. So here's what you need to know before the bell this morning. So yesterday the markets rallied very, very nicely. We had about a 2% rally on the news that Trump had paused the tariffs on Eurozone, at least until July. So that gave the markets a bit of relief about, what tariffs are. And interestingly enough, by the way, speaking of tariffs, we wrote an article in November of 2024, so right after President Trump was elected. And of course, the fear at that time is that these tariffs are going to be very inflationary. And we said no, right? We said Trumpflation's not the risk to be paying attention to. And tariffs don't create inflation historically. They're actually deflationary by nature because it crimps consumers. It's a tax on consumers. Interestingly enough, we wrote that article in November, laid out all the reasons why that tariffs are not inflationary. Today, Goldman Sachs comes out and says, we've changed our mind. Tariffs are not inflationary because they have a deflationary impact on the economy. No kidding. So glad to see that Goldman Sachs catching up with us. But this has a lot to do with the markets because this whole rally has been on the realization that these tariffs are not as inflationary as expected. They're not that big of a hit to the economy. People are starting to come to that grips of this, and also the pause, the delays, the reductions, all those type of things. We went from this big, stick attack by Trump on international countries to now this reprieve. So here's the carrot that we were talking about previously. But money flows are very, very elevated. When you see money flows this elevated, and this goes back historically, but we're at levels normally where money flows are typically towards the peak of a market advance, not the beginning of a market advance. So again, when money's flowing in, there's only so much money that can flow in without having some type of correction or profit taking first. So just one thing to note is that money flows are very, very positive. And again, if we just go back and look, you can see this every single time that money flows are this elevated. They can stay that way for a while, but they're typically just prior to a point to where you get some type of correction, at least short term in the market. So again, kind of pay attention to that. Of course, we're very overbought, close to a MACD momentum sell signal. Relative strength is still very elevated here. So again, nothing critical about this, but just understand that we've come very far, very fast. And as we talked about lately, just, this is probably a good time to start taking a little bit of profit, out of the market. Let's talk a little bit about Nvidia, because as they report earnings tonight, again, money flows here into Nvidia since this bottom have been absolutely stellar. We've just had a massive surge and massive push of money flows going into the stock. Of course, that's been elevating the stock price. Nvidia is up about 40% from the lows. So still about 14% below the all-time highs for Nvidia, but up 40% from the lows. So it's not been a chump change rally at all for Nvidia, but very, very overbought on a momentum basis, very overbought on a relative strength basis as well. So the risk tomorrow after earnings is to the downside because we're not going into the report with low expectations in terms of the markets. The markets have already run the stock price up very well relative to the earnings announcement. So unless this, and so what that suggests is that unless the report is just a real blowout or there's some announcement by Jensen Huang about the future that nobody was expecting, the risk tomorrow is that we get a little bit of downside on this, or we get a muted upside. Even if the stock is, earnings are really good, maybe you get a 1 or 2% advance tomorrow. The options market right now for Nvidia is pricing in a 7.5% move in one direction or the other. That would push up, Nvidia up above 140 if that would occur. But again, because the market's already so overbought and extended and money flows have already chased the stock so much, the risk is really kind of for a muted outcome tomorrow. The risk is really to the downside more than anything else. It doesn't mean go sell the stock, right? But we trimmed our position back to target weight yesterday just to hedge that risk of downside following the earnings announcement this afternoon. That's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff. We'll talk about Nvidia's earnings expectation for and some other topics this morning as well. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Danny Ratliff joining me this morning as well. Morning, Danny.
Morning, Lance. How are you?
I'm good. A little sleepy this morning. Didn't get in bed till late. My wife's I don't sleep well when my wife's traveling. So just, you're used to having somebody around all the time. And so I just could not go to sleep last night. So I didn't fall asleep till like 10:30, 11 o'clock. And that alarm clock came very early this morning.
The wind wake you up?
No.
We know what the real deal here is,
What
Brent.
is?
She's the protector.
She is.
That's what
Absolutely.
it is. I mean,
Absolutely.
there's no doubt about it in my mind. Everybody thinks Lance is big and tough, but the alligator, maybe the moats ran dry. They've been moving around a little bit. I mean, something happened here.
Exactly.
Yeah.
No, I tell you what, you don't want to mess with my wife. It's funny, like people in our office, they're like terrified of my wife. Every time Richard sees my wife in the office, in the building, he's like, I saw Mrs. Roberts this morning. I'm like, it's okay. She's not going to bite.
He gets in the elevator, scoots over, and puts his head down.
He does. Chris Behan is the same way. He's terrified of my wife. And I don't know why. Well, I do know why. But
Well,
I think she's a very sweet woman.
No, she is. She's fantastic. But I think everybody, they see her out of context, right?
They see her in business mode.
Yeah.
Yeah.
And you're like, wait a second. Is that? Yeah.
Yeah. They see her when she's in business mode. You don't want to mess with her. So anyway, just for the break, talked a little bit about Nvidia reporting tonight. So just thought I'd just go through again. And the reason that this is important is just because it's all about the AI trade. And I saw a recent clip with Jensen Huang talking about the future of what they're developing, particularly with the Blackwell chip and some of the new developments that they've got coming along. And he made a very interesting point. He says, we're not building AI data centers. He says that is a misunderstanding. So when there's been all these charts out about the data centers we're building these data centers, and there's the capacity and what happens if we overbuild capacity? And he said, look, we're not building data centers. A data center is just where you build a center, you put a bunch of computers in it, and you rent out the space to other people. That's a data center. He says, we're not doing that. He says, we're building factories. AI factories. And he says, when you build bigger factories, you make more money. That's just the way it works. And it's a very interesting concept, because when you start thinking about industrial revolutions, when we were building factories back in the 1900s to, automate the production of automobiles and to automate the production of farm machinery or whatever it was, as we were industrializing and coming up with new ways to leverage the steam engine and eventually the combustion engine into workable products for the economy grew. It became stronger. And we were able to do more with less. Think about the importance of just being able to have a steam train that could take you from coast to coast. When we built railroads, all of a sudden you opened up the entire country to development, production, jobs, all these type of things, the gold rush in California. So all these things occur with industrialization, and AI is the next leg of industrialization. It's the game changer for industrialization. And so we're very early in that. So while there's a lot of people out there poo-pooing the idea about AI and it's not going to make money, it's not about AI making money. It's about making every other business more profitable and creating businesses that we aren't even aware of yet, that will come from the industrialization of artificial intelligence. And so this is what he's talking about. And as he was showing off one of his chips that they were making, it's a board that's about 2 foot by 2 foot. He says this one chip by itself can handle all of the traffic of the internet at one time. All of the traffic of the internet at one time. And so when you start thinking about the ability to process data and all this, there's a whole different facet of what AI is going to be versus what a lot of people think it is. And so this is why people are very, keep worrying about AI's revenue growth and earnings growth. Understandable, right? But they keep developing and growing and finding new ways to innovate in that space. And so that's going to be big. And there was a very interesting news headline out yesterday talking about, and I'm going to forget the name of the city. I think it's in Idaho somewhere. I'll think of it in a moment. But SpaceX is building a massive AI data plant in this one particular city. It's up in the Northwest somewhere. I'll have to look it up. Danny's looking it up for me. Thank you. But anyway, this is a massive build out. This is just one plant, right? And for SpaceX. And so you think about all these companies that will be building out these factories to use AI for their business, whatever their business is, whether it's SpaceX or Tesla or whether it's General Electric or GE Vernova, whatever it is. These are all, then of course you think about the downstream of all this, of course, power generation, power needs, infrastructure build out the buildings, et cetera. So, it's big. It's very big. And so when you start talking about earnings, then let's get to NVIDIA's expectations. So tonight, NVIDIA is expected to announce earnings of about 92 cents a share. That's above Wall Street estimates right now. So they're expected to come in pretty heavy. Analysts are predicting a significant increase in revenue, with some forecasting a 66.2% year-over-year improvement. NVIDIA expects quarter one fiscal 2026 revenue to be approximately $43 billion. That's $43 billion in a quarter. So this is not chump change. GAAP and non-GAAP gross margins are expected to be 70.6 and 71% respectively. Again, you're building gross margins of 70%. Most businesses, just as a perspective, run gross margins around 20. So again, when you start thinking about, been a lot of talk about NVIDIA's valuations and about this is a company that has a PEG ratio, which is price to earnings growth, of about barely above 1. So it's in Washington? Redmond, Washington. Thank you. That's right. So the SpaceX are building Redmond, Washington. Why they're building it in that state, I'm not sure. But anyway, they're also building an entire town in southern Texas. So that they're working on incorporating now.
Yeah, and they have a new semiconductor R&D and advanced packaging facility in Bastrop, Texas.
Right. But no, they're actually...
It'll be the largest of its kind in the States.
Correct. But in southern Texas, where they actually launched the rockets from, they're actually trying to incorporate SpaceX to make it SpaceX City. So we may have a new city in Texas from this as well. And a new congressional district. There you go. Analysts also suggest strong demand for AI, indicating that Nvidia's earnings could be bolstered by the trend. So again, expectations going into earnings are very, very elevated. And again, with the stock very, very elevated in price, there is risk of disappointment. In other words, if they just come in line, and again, this is the risk with optimism, is that if they just come in line with these very optimistic expectations, that will be a disappointment. And the stock could sell off because it's very overvalued, not overvalued, but very extended right now after this recent run. So, there is risk to the downside. This is the reason we kind of trimmed our position back to target just recently, going into earnings, just to kind of hedge off some of that potential risk, because the expectations are pretty elevated here.
I don't think it's just that risk. It's the risk of what the forward guidance looks like,
Yeah,
or what exactly happens. I mean, they may even beat, but if he's not extremely optimistic,
well, he will be.
Yeah, he historically is. But the stock has a tendency to run up before earnings and then take a little dip for a while.
Yeah.
And kind of finds its grounding once again and then kind of moves forward. But who knows?
But no, and again, if it does, but we've seen reports where the stock opens up 20% the next day, and it goes from 2 standard deviations to 5 standard deviations overall. Then it pulls back, right?
Yeah.
So again, it's unknown what the stock will do tomorrow. And again, just as a precaution, we trimmed our position back just a bit, and we may give up a little bit of the gain tomorrow just because we have a reduced position size. But it's just back to target because the stock has had a huge run. It's up 40% from the lows. We were overweight, pulled it back to target. That's all we did. So
took some profits.
Yeah, took some profits. Anyway, so enough of that. But there's a lot of stuff that'll be going on. But this officially wraps up earnings season for the most part. I mean, there's a few little stocks that are still coming out over the next few days. But for the most part, this is the last major company reporting earnings. Abercrombie & Fitch reports this afternoon. C3 AI, which is another AI company, but they're small. Dick's Sporting Goods, Elf Beauty, Macy's, and Salesforce report today. But Nvidia is the dog in the hunt today. That's Salesforce, yeah, whatever. Nvidia is the one. But also, too, what's important is that stock buybacks are going to start, as I talked about yesterday. Stock buybacks will start to close down now in the next couple of weeks. As we get to about June the 15th, we're going to lose the support from corporate buybacks because we're getting ready, believe it or not, for earnings. As we just finish earnings, we're getting ready to start earnings again beginning in July. So in the next 30 days, we're going to lose the support of buybacks, and that may weigh on stocks here a little bit, just the overall momentum, because there's been a huge rate of change in the amount of buybacks from the April 6th lows. We've had a very, very big surge in buybacks coming into the markets to take advantage of that lower price by companies, and they've been doing a lot of stock buybacks. So again, that kind of risk is just that lack of purchasing power as we get ready to go into earnings season for the second quarter. Sorry. All right, come back, pick up with Danny Ratliff. A lot of stuff to talk about this morning. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Retirement looks a lot different now than what it did many years ago. It's just maybe working less. Still want to contribute and be active in the community.
And
Absolutely.
Plus, when you're 70 and you can make TikTok channels and make money off of it.
The Real Investment Show podcast.
Is that what you're going to do?
I've already started it.
Oh, okay.
It's OnlyFans for old people.
Oh, my goodness.
At realinvestmentadvice.com.
Want to see my feet?
I'm out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. We are streaming live on X this morning as well as we start our venture out into multi-stream platforms, multi-platform streaming. So YouTube, X, more to come. So I've got Brent working hard in the background over here. So every time I come in with a new idea, he's like, "Oh Jesus." Hey Brent, what do you think about "Oh Jesus"?
He's just like, I need one more thing to do, Lance. Like,
oh, you
know
do?
what?
Okay, good. I've got more. So anyway.
Hey.
Yes, sir.
Speaking of.
Real quick, before you take off on that. We are having one of our very few live events this year. It is coming up June the 14th at the Hyatt Centric in the Woodlands. This is non-recorded. It will not be produced on the internet. It is a live event only. So if you want to go, you need to sign up now. We haven't really advertised this a whole lot, and it's almost full already. So there's only limited seating at the Hyatt Centric. So if you want to go, you need to get your registration in now. You can just simply go to our website, go to the events tab, click on the link for it, and register. Get your name in. Love to see you there. They're going to be going through everything about retirement income, how to create income in retirement. And of course, this is one of the big challenges for retirees is how to create income in retirement without having to wind up paying tax on Social Security and impacting your other benefits and all these other things that come along with trying to create income in retirement. They're going to go through all those strategies at this event. So if you're, getting close to retirement or in retirement, needing to generate some income, worried about the impacts from doing that on your other retirement benefits, this is the shop for you to go to. They're not selling you anything. This is just all informative, but you need to register. Again, seating's very limited and it's almost full. So
yeah, great opportunity to meet the team, answer, it's going to be live. So any questions you guys may have, we'll certainly try to stick around and answer afterwards. These events do typically fill up, but this time seems like it's been much, much quicker. Mm-hmm. And so we're having to rearrange rooms and see if we can't get more seating involved. So there is limited seating.
Right. Yeah.
But yeah, it'll be hopefully, we'll talk about Social Security taxation, and then maybe we won't have it.
Maybe
all these new bills, all of these things that are keeping probably everybody on the edge of their seat a tad bit. At least it is for us, because we're trying to navigate all the things that you guys need to be thinking about. But it'll be something that will be changing over time. And so to what extent, that is the question. And that's something that we do on a regular basis, is make sure that we try to keep you guys informed, keep our clients informed, making decisions surrounding how to take income. It's funny because, Lance, we visit with people. We have people that call in and they want to visit with somebody, and they say, hey, I just want to introduce myself. I'm going to call you in 4 years or 5 years when I retire. And then we'll build out a plan. I'm like, whoa, hey, there's never too soon of a time to start working on that plan, because number one, now you can begin to look at how do you need to accumulate funds? Where should you put them? And we're going to talk about that. And so that way, when you get into retirement, you're not stuck with everything in a pre-tax account. And we still see that often.
Oh, yeah.
You may have amassed a great amount of money in a 401k, and that's fantastic, but you've basically given up all control from a taxation perspective, and then even from an income perspective on different types of investments that you'd invest in. It may be counterintuitive in some ways to invest in some of these inside of an IRA.
Yeah.
So, those are things we'll be discussing. But yeah, it'll be a good time.
Speaking of income and retirement, the guy that created the 4% rule says, yeah, maybe that's not the right number anymore.
There's so much information out there. And so the 4% rule, what do you think when you think of that, Lance?
Well, it says that when you retire, I can take 4% of my money, and if all my other assets are invested in the stock market, it generates a 8% average rate of return every year. So I'm picking up a 4% growth in my investments, and I'm only taking 4% out, so I never run out of money, in theory.
In theory, right?
But that's the big caveat.
The big caveat that you had was you never run out of money. And so we hear people all the time that call in and say, hey, or clients, right? You guys, this is always a concern, and we're always trying to navigate this, is that, hey, I can take out 4% and not touch my principal.
Right.
But
that's not what it means.
That's not what it means. It means you can take out 4% plus inflation adjustments and not run out of money. And there's a big difference. So Bill Bingen came up with this in 1994. And, in fact, he was just doing this with a number of his clients at the time, right? Small shop, sole practitioner, just running analysis, right? And I love it. It's great. And it's taken on, it's funny. He said, I got death threats over the 4% rule. And I get it. Because it makes, if it didn't work for somebody, they're like, what? But it's also, how are you invested? What did the study look like? But he's actually come out and he said the original number was 4.15. He rounded it to 4 because of that. So he wrote another book in 2006, 19 years ago. And he said that number now is likely 6 or 7%. He says we do have, not so high inflation when he was first going backwards, right?
Right.
So he's back testing this. And he's like, well, 1970s really screwed things up. High inflation. You had a lot of different types of volatility going on. You get into the 80s, things improved. Wage growth was great, but inflation was still rampant. But now he's saying he believes that you can take more out. Now, there's another caveat, though. And this is what most people don't think about. What age are you retiring? How much have you saved? And so in general, that shouldn't matter a whole lot. But when you think about it from what you actually need, if you haven't saved a lot and you don't have an emergency fund, you don't have all the rest of those things set up, well, then you're likely at times, what's your piggy bank if you have an emergency? It's these assets. So then we go way over that amount from time to time. And you know what? We can argue that's okay. If we're doing it in an up market when things are doing very well, or you've had consecutive years where you haven't taken as much out. But there's also an argument to be more dynamic in nature, where some years you take more, some years you take less. And I think for many people, the concept around that is something that's tough to wrap your head around, right?
Well, and there's also a lot of fallacy to that. I wrote an article a few years back. Michael Keitzes, who's a big financial planner, had come out and written this article about the 4% rule, right? And he had this graph where it was a nice smooth bell curve of kind of withdrawal rate, your accumulation and then your withdrawal in retirement. And the principal does decline a bit as you're going into retirement, but you never run out of money. Well, the problem is that the study missed 3 very important things. And when you include these three very important things, all of a sudden, that nice smooth bell curve looks dramatically different. One is that markets don't compound at 8% a year. This is a huge fallacy in planning. And so a compounded average rate of return is vastly different than actual market rates of return.
Well,
So,
of course, now you're looking at, it's like when people say, well, what about the rule of 72? I've averaged 7-8%.
Yeah.
But yet my money hasn't doubled. But that's only good when you're using a fixed rate of return. And that's the problem with many plans in general, is that they're assuming for a stagnant return, more or less, right? It's going to be fixed.
Right, and then they don't include fees on money management or your mutual funds or whatever, which is also, so if I'm going to take out 4%, so let's say that my withdrawal rate is 4%, but I've got a 1% fee on top of all my mutual funds as an example. So now my withdrawal rate's really 5% because I'm paying that fee too. So, you've got to include these fees. And then of course, taxes. Taxes are never included in any of this. And, when I start, and this is one of the problems as they'll talk about in this upcoming event, is that one of the mistakes that I see a lot of people make, Danny will tell you this too, is that when we're early in life, we don't want to pay taxes, so we shove everything into IRAs or 401ks, and it's all great, fine, and dandy because you're not paying taxes now. But in a lot of cases, you're a lot better off to pay taxes now, and this is what Danny was saying, is you can control your taxation in retirement. Pay some taxes now, have some money that's already had tax paid on it, because when you get into retirement, all of a sudden now every withdrawal you're taking out of all those tax deferred accounts is an additional impact because of the taxes you're having to pay on that money. So all of a sudden that 4% withdrawal rate, you're coming home a whole lot less. And so when you start looking at the potential for running out of money before you pass away, when you start including these other factors like market volatility, fees, inflation, paying taxes on your dollars, all of a sudden that longevity of your capital becomes much, much shorter.
Well, I think that's why we need a plan.
Yeah.
I laugh because I always go back to that.
Well,
but if you do,
and
you're going to be able to say,
right.
You're going to calculate it. But I'd rather even be more conservative on the plan and say, hey, what if worst case scenario? But we can factor that in and say, okay, this is with fees, this is with taxes, and then we can actually say there's a hierarchy of how you actually spend down your accounts or take distributions, and that may change based on the tax environment, what we have going on, how much money you need. But if we know you need X amount, we can say, hey, take it from here, here, and here. Now, a lot of times in the first year of retirement or first couple, because sometimes there is some moving parts and maybe targets with income, we will say, hey, let's go ahead and just draw down this year your taxable account. And the end of the year, let's run an analysis, see if anything has changed significantly, and then we'll go out and make a distribution. So, from say a pre-tax account.
Yep.
But, when Bill Bengen set this up, it was essentially saying that, he used a simple portfolio of 2 asset classes, U.S. large cap stocks and 5-year bonds. Over time, he built a more balanced portfolio by using U.S. large cap, mid cap, small cap, micro cap, international, and intermediate term U.S. government bonds and T-bills. So the funny thing about this rule is that this changes. So it's not set in stone. He's even changed the rule multiple times. But Richard and I went back and looked at studies over the last couple of years when we had interest rates near 0. And guess what that withdrawal rate was? It was 2 and change. And so I think retirees are going to have to start thinking a little bit differently about retirement and how, number one, what do you need? What do you truly need in retirement? Number 2, how much variability can you give yourself? And we can talk about that on the other side of the break.
We can. But you can also find out a lot more about it at the upcoming event in the Woodlands, Hyatt Centric, June 14th. Register online now at realinvestmentadvice.com. Love to see you there. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Need help?
These bots on X are out of control. It is just amazing. Every post that we put up, it has like 30 bots on it immediately, like within seconds.
So what are the bots telling you to buy their
No,
stock?
it's I follow this guy because he's got great technical analysis or whatever, and it's just all bots. And it's like we put up a post, and it's like immediately like 15 of these show up, so I have to go and block every one of them. It's a hassle. It's a full-time job for somebody just to block bots on X. It is.
Have you
on YouTube as well?
Have you let Mr. Musk know?
I have. I have sent tweets to him or X's. What do you call it?
I don't even know.
What do you call a post on X?
What?
I don't know.
Did you just make that up?
Yeah, he did. Anyway, yes, I've sent notifications to Mr. Musk, and he has not replied or solved the problem as of yet, because apparently I don't matter. But there you go.
Elon, I know you're listening. Come on, buddy.
Exactly. All right. So anyway, just talk a little bit about kind of this idea of this 4% rule. And again, a lot of this comes down, and again, somebody in our YouTube chat made a good comment, is that these rules are guidelines; they're not absolutes. Correct. And this is the way to approach this type of thing when you're heading into retirement, wanting to get retired. Looking at these rules and just don't take them as ironclad. Because one of the mistakes I also see, Danny, is that with bond yields at 5%, people are going, hey, if I can get a 30-year treasury at 5%, this is great. I only need 4% for retirement. I put my money in 30-year treasuries at 5%. Mm-hmm. I'm good. I'm golden. No, you're not. And the reason is that over the next 30 years, you're going to get 5%. Let's say you put $1 million in 30-year T-bills at 5%. So great. You're going to get $50,000 a year in income.
Yeah.
In 30 years, you're going to be getting $50,000 a year in income, but your cost of living over 30 years because of inflation at 2% a year is going to be dramatically higher. So the bonds don't adjust for inflation. This is why you must have equity exposure in your portfolio to allow the equity side of your portfolio to be the inflation adjustment. And so you think about a portfolio like a 60-40 allocation, where I have 40% of my money in a 5% treasury bill. As an example, I have 60% of my money in S&P stocks. Well, when the market goes up, it gets out of balance. I'm now 70% stocks, and my 40% bonds are now 30%. So I need to sell 10% of my stocks, buy 10% more in my bonds, rebalance that portfolio. That brings my income up, so that now I'm collecting more income in my portfolio for which I can live on. And so that's how your equity portion of your portfolio adjusts for inflation over time, so that you can meet your living requirements over a very long, extended period of time. But buying bonds, thinking you're going to get 5%, you're good, because you can just take 4% a year. That's fine, assuming your cost of living never changes, which isn't going to be the case.
Well, but I also know, and you know this, sometimes that's a difficult thing to do, right? It sounds great in the moment.
Oh, yeah. Until the market
what are you
going to
do when the market's up 20%?
Exactly. No. Well, how many people did we see in 2022 that called us up or went other places or just told us that they were doing T-bill and chill? I'm gonna buy 5% T-bills and I'm just gonna chill out, right?
Oh, a ton.
That was great in 2022, right? Market's down 20%. It's a grinding decline. I'm sitting sweet in 5% T-bills. That's great. Then the next 2 years, markets are up 20% a year. We saw those same people trying to figure out how to panic sell to get out of those treasury bills to get into the stock market.
That's right.
And this is always these are those psychological mistakes. We talked about anchoring yesterday on the show. These are those psychological mistakes that lead to very poor outcomes for investors.
Well, even with any of this, all of these need to be done with a goal in mind. What is it that you're trying to achieve? What are you working for? These funds that you're accumulating, what is the intent of them? The intent should be for you to retire at some point or do the things that you love and enjoy. And so we need to attach that goal or specific things you'd like to accomplish with them. And then you can say, okay, can I still meet my goal? Because we're going to have volatility. We've talked about the price of admission in the stock market should be a minimum of 10% decline. So when we think about those things, we have to have some rationale assigned to it, that we can't just jump in or jump all the way out, because we're going to get on the wrong side of this at some point. You may hit one thing just right, but it's extremely difficult to do it on both ways, in and out,
right,
or vice versa.
No, that's right. And again, this is those, we spend a lot of time writing. If you go to realinvestmentadvice.com, we post articles 3 times a week. We have a newsletter on the weekend that are just going through kind of all this analysis of the markets, investing. But most importantly, we focus a lot, and particularly lately, we focused a lot on, psychological mistakes, investor behaviors, because this is where, the market's been running up lately, and you've been hearing a lot of stuff about, there's the deficit, Ray Dalio, the deficit crisis is coming. It's within 2 years. Got an article coming out on Friday.
2 years ago.
It was 2 years.
10 years,
40 years ago, because he said this in 1980. So, the problem with these end of the world type predictions and that the market's going to crash because of valuations, there are certainly some risks that are out there. I'm not denying those risks at all. I'm not saying that there aren't risks. There's always risk in markets. That's why we invest, because the risk is where we build our returns from. But we also need to understand that these tail risks, which are certainly a possibility, are not the likely probabilities of outcomes. And so we need to make sure that we're tempering our expectations, tempering our outlooks to being more probabilistic about outcomes versus these tail risk possibilities that if they occur, they're bad. Right? I mean, we had a crash in 1929. We had a crash in 1974. We had a crash in 2000, 50% decline. We had the financial crisis of 2008. I'm not denying that these tail risks can occur, because they do occur, but they've occurred 4 times in 140 years. So what's the probability of them happening next year or the year after? And making decisions to, shelter all into one asset class, whether it's bonds or gold or stocks or whatever it is, typically turns out poorly for one reason or the other. This is why diversification of assets and diversification of your strategies can be much more, protective in volatile markets going forward. And again, the volatility risk in the markets going forward is higher than it was 20 years ago because things are moving so fast now. We have so much in hedge funds and computerized trading algorithms and fast money flows and fast information. All these things are changing very rapidly. Volatility is going to be something we have to become accustomed to in both our planning, when we're planning for retirement, how we're going to make withdrawals. We have to plan for volatility events. And again, Danny made this comment earlier. I don't know if you caught it, but he says, look, you got to have years where you don't take as much out, because if you're taking 4% out in a down year, market's down 10, 15, 20%, you're taking out another 4% on top of that. Your net effect of that is not a 24% decline. It's more like about 28 because you're taking money out in a declining market. So you're selling assets as you're declining. So that's a year where you need this emergency kind of fund sitting aside in cash. It's not doing anything, it's just sitting there. But that's the year that you go to that pool of money and take money out from there to live on and allow your assets to do what they've got to do in the storm without taking additional drag out of your portfolio.
And that could be in the shape of many different things.
Sure.
It may be a cash value you have in a life insurance policy, a permanent policy. It may be just the emergency funds that you have on the sideline. It could be money that we've already put into cash or cash alternatives in the account, so we're not having to necessarily sell more of something that's already declining. And so there's no perfect way, but if most people and most firms are going to say, Lance mentioned a 60-40, we're going to be 60% stocks, 40% bonds, regardless of economic conditions, regardless of the market, we're going to diversify. And that's something I want to touch on next week with you.
Right.
Is I think what diversification means to you and me
Are different.
Is much different than what it means to the average mainstream media or the average financial advisor, or maybe even you guys out there. I think we think of it maybe a little bit differently. And it may not be perfect, but it's different. And, so we need to factor all of these things into it. And that's the trouble that I think many people run into is this: we're trying to make these types of changes, right? You're trying to draw down assets in a declining market. Number one, it's difficult. But number two, I do see, Lance, inherently, people do a pretty good job of pulling back when things aren't great. If all of us know somebody that's out of a job, or if a loved one is going through, trouble with work or whatever it may be, economic dire straits, are we spending as much money? I mean, I can remember just in years recently where, I would look at a client's plan and say, hey, you got summer travel planned? Oh, we did, but we canceled it. Well, why? Oh, it just didn't feel right. Things aren't great, 2022, 2020, whatever it was. And wait, the plan says you can still do that. You guys have been doing a great job. But human nature, we do pull back when things are bad. The problem is we may pull everything back. Yes. That's what gets us in trouble.
Yeah, we'll talk some more about that next week because that's a big issue. Futures about flat this morning. Not a lot going into this morning. We do have GDP report out this morning, PCE, inflation year over year coming out on Friday. So we've got some economic data out this week that'll kind of be moving markets. But right now, it's all about Nvidia this afternoon. So we'll talk about what they say tonight in the morning. We'll pick up with Michael Leibowitz tomorrow. We'll talk about interest rates, bonds, more, what's going on there as well on tomorrow's edition of The Real Investment Show. Have a great day.